You didn't tell me it's 2 minutes. Good day. Since January, the Omicron wave of the COVID-19 virus has transmitted globally with diverse social and economic outcomes. Despite the high infection rate, many economies remained open, and with some exceptions, the economic costs of the virus continue to fall. Even as the economic impact of the pandemic fades, the outbreak of war in February between Russia and Ukraine is expected to reduce global economic growth and contribute to higher inflation. The war will likely impair production of a wide range of energy, food, and other commodities, and further disrupt global trade. The SARB's forecast for global growth in 2022 is revised down to 3.7%, and for 2023 is lowered to 2.8% as a result of the war and the ongoing spread of the virus in Asia and elsewhere. For 2024, global growth is unchanged at 2.7%. Dramatically higher oil, commodity and food prices, additional constraints to trade and finance, and rising debt costs create more adverse economic conditions for most emerging and developing economies. Although policy settings in advanced economies remain broadly accommodative, the onset of policy normalization by major central banks and higher inflation has tightened global financial conditions. Investor appetite for riskier assets is lower. Economies that failed to take advantage of better global conditions or to reduce large macroeconomic imbalances remain vulnerable. Last year saw the ongoing recovery of the South African economy from the pandemic, expanding by 4.9% for 2021 as a whole, which is marginally higher than the 4.8% we had forecast in January. The South African economy is expected to grow by 2% in 2022, revised up from 1.7% at the time of the January meeting. This is due to a combination of factors, including stronger growth in 2021 and higher commodity export prices. Growth in output in the first quarter of this year is likely to be significantly stronger than expected at the time of the January meeting. GDP growth is forecast to be 1.9% in both 2023 and in 2024. Economic growth at these rates remains well above a low rate of potential growth, which is still considered constrained by load shedding and policy uncertainty. Investment by the government sector has weakened significantly in recent years, and that of public corporations is forecast to be very modest. Household spending remains supportive as a result of good growth in disposable income, rising asset prices, and low interest rates, while private investment has also proved to be more resilient than previously expected. Overall, and after revisions, the risks to the medium-term domestic growth outlook are assessed to be balanced. With the low rate of potential growth at present and the upward revision to GDP growth for 2022 and 2023, the output gap closes faster over the forecast period compared to the January meeting. The output gap is expected to turn positive after the third quarter of 2023. While important commodity export prices such as for coal, iron ore, platinum, and rhodium generally decreased in the latter half of 2021, they increased again late in January and have surged further with the outbreak of hostilities in Europe. Oil prices spiked to around $130 per barrel in the early days of the conflict before easing somewhat. We expect oil prices to average $103 per barrel for 2022, $80 in 2023, and $75 in 2024. South Africa's commodity price basket is forecast to rise by 8% for the year as a whole, keeping the terms of trade elevated before falling sharply in 2023. As a result of these export and import price developments, the current account surplus is expected to increase to about 3% of GDP this year before easing to 1.6% in 2023 and 0.8% in 2024. Although fiscal risk has eased, financing conditions remain tight and the yield curve for rand-denominated bonds is steep. 10-year bond yields increased to about 10.3% in late February before easing back to around 9.7% at present. The first 2 months of this year featured a weaker rand exchange rate, resting somewhat below its equilibrium level. Since then, and despite less favorable global conditions, stronger commodity export prices have appreciated the currency and helped to dampen price pressures. The implied starting point for the rand forecast is 15 rands 41 cents to the US dollar, compared with 15 rands 60 cents at the time of the previous meeting. As the global economy rebounded from the pandemic, aggressive policy easing and supply shortages that have increased prices of many goods and commodities. These increases have passed through to services prices, wages, and consumer prices in major economies. Our estimate for inflation in the G3 is revised higher throughout the forecast period to 5.6% in 2022 and to 3% in 2023 before moderating to 2.3% in 2024. Oil prices are revised up further for this year, and fuel price inflation is higher at 26.1%. Local electricity price inflation is revised down for 2022 and to 9.2% in 2023. For 2024, electricity price inflation of 10% is expected, unchanged from the previous meeting. As a result of higher global food prices, local food price inflation is also revised up and is now expected to be 6.1% in 2022 and 5.1% in 2023. Food price inflation is forecast to ease to 4.4% in 2024. The bank's forecast of headline inflation for this year is revised higher to 5.8%, primarily due to the higher food and fuel prices. While food prices will stay high, fuel price inflation should ease in 2023, helping headline inflation to fall to 4.6% despite rising core inflation. Core inflation is forecast to increase to 4.2% in 2022 and to 5% in 2023 before easing somewhat to 4.7% in 2024. Core goods and services price inflation is forecast higher throughout the horizon, and services price inflation exceeds the midpoint of the target by the fourth quarter of this year. The risks to the inflation outlook are assessed to the upside. Global producer price and food price inflation continued to surprise higher in recent months and could do so again, particularly if the war in the Ukraine persists into the growing season. Oil prices increased strongly through 2021 and are up again sharply year to date, propelled higher also by the war and economic sanctions. Electricity and other administered prices continue to present short and medium-term risks. Higher diesel and coal prices may result in upward revisions to our electricity price forecast for 2023. Given below inflation assumptions for public sector wage growth and higher petrol and food price inflation, considerable risk attaches to a still moderate nominal wage forecast. Global financial conditions are more volatile at present, and with higher than expected inflation, has pushed major central banks to start the normalization of global policy rates. On balance, and with some exceptions, capital flow volatility is expected to remain high for riskier assets such as emerging market debt and currencies. Average surveyed expectations of future inflation have increased to 5.1% for 2022. Market-based surveyed expectations for inflation have also increased to 5.5%. Long-term inflation expectations derived from break-even rates in the bond market have also increased. In the near term, headline inflation has increased well above the midpoint of the inflation target band and is forecast to breach the target range in the second quarter. Headline inflation then returns close to the midpoint in the second quarter of 2023, taking into account the policy rate trajectory indicated by the bank's quarterly projection model. Some risks to the inflation outlook, like food and fuel, have been realized, and other risks, such as currency volatility and capital flow reversals, have become more pronounced. Against this backdrop, the Monetary Policy Committee decided to increase the repurchase rate by 25 basis points to 4.25% per year, with effect from the 25th of March 2022. 3 members of the committee preferred the announced increase, and 2 members preferred a 50 basis point rise in the repo rate. The implied policy rate of the quarterly projection model indicates gradual normalization through to 2024, given the inflation forecast. As usual, the repo rate projections from the quarterly projection model remains a broad policy guide, changing from meeting to meeting in response to new data and risks. Economic and financial conditions are expected to remain more volatile for the foreseeable future. In this uncertain environment, policy decisions will continue to be data dependent and sensitive to the balance of risks to the outlook. The MPC will seek to look through temporary price shocks and focus on second-round effects and the risks of de-anchoring inflation expectations. Current repurchase rate reflects an accommodative policy stance through the forecast period, keeping financial conditions supportive of credit demand as the economy continues to recover. The bank has ensured adequate liquidity in domestic markets and will continue to closely monitor funding markets for stress. Better anchored expectations of future inflation could support lower interest rates and can be realized by achieving a prudent public debt level, increasing the supply of energy, moderating administered price inflation, and keeping wage growth in line with productivity gains. Such steps will enhance the effectiveness of monetary policy and its transmission to the broader economy. This brings to the end our statement, and we would thus invite members of the media to pose questions. And Ziyanda, I suppose that you will see who is online there.
Thank you, Governor. We've got a question from Lucanio at Business Day. With inflation and the cost of living crisis having become subject of political protest across the world, does the bank now feel the debate about whether there is a trade-off between inflation and growth settled? After being criticized for his move, does the governor feel vindicated? That is the question we have for now, Governor. Thank you.
Well, in economics, it's of no use to chest beat and say, I told you so. What really matters is to restate what we have always stated. There is no virtue in higher inflation. The higher the inflation, the higher the interest rates are going to be in the future. The poor cannot protect themselves against the ravages of inflation. Those on fixed income, like working people, cannot protect themselves against the ravaging effects of inflation. It is for that reason that it is considered prudent in functioning democracies to have a central bank tasked with a responsibility of maintaining and protecting price stability. And so the fact that you are having elsewhere in the world people protesting against rising inflation and rising prices is testimony to the fact that the general public would like to protect their standards of living rather than seeing their standards of living being eroded by rising inflation.
Thank you, Governor. We've got a couple of questions, about 3 from Pranisha at Bloomberg. She's asking, can you please outline the argument given by the 2 MPC members that preferred a 50% basis hike? Why did the MPC ultimately decide against it? Her second question, can you please quantify the impact of each 25 basis hike on both inflation and economic growth? The next question, some of South Africa's emerging market peers are hiking quite aggressively, and the Fed has signaled that it may do the same. Are you concerned about falling behind the curve? To what extent have the changing global and domestic conditions affected your tolerance of a negative real rate? Those are all the questions for now. Thank you, Governor.
Is that all? It's only Pranisha?
It's only Pranisha for now.
Okay. Chris, I'm going to give you the question about the impact of each 25 basis point risk. The arguments advanced by the 2, I don't know who the 2 are, Pranisha. Why don't you ask about the arguments advanced by the 3? No, that kind of hunt is not going to help you. What you are seeing in the statement that we have just presented is the collective view of this committee. Whether getting into the committee, there were people who preferred that we hike by 25 basis points or by 50 basis points. The split preferences of the MPC members is just a reflection of the uncertain environment in which we are operating. We have got to make judgments. Of course, what we can't do is to come to the press conference and say we couldn't reach an agreement. At some stage, an agreement has to be reached, and that agreement is thus captured in the statement that we actually have. There is a lot of uncertainty, and we have experienced not one shock. When you experience one shock, you normally just see through and say that we do not have to do anything, let us wait for evidence of second round effects. When you have got a multiplicity of shocks like we have had now, the oil price, the food price, supply constraints, the war, you have got a multiplicity of shocks. It then leads to a situation where you have got to ask yourself whether the prices are starting to feed through. What is in no doubt is that the prices are starting to feed through, as we see with core inflation rising. What the committee had to grapple with was to extent to which this has taken place, and to what extent should we embark on particular quantities of the policy stance in order to cap that. And after deliberations, the agreement that was reached was that we will increase the policy rate by 25 basis points. There are risks on the horizon. There is a lot of uncertainty. There is volatility, current and expected, and the MPC will continue to assess those volatilities and those risks. And should there be an indication that the risks are materializing, the MPC will act appropriately. EMEs have been hiking, and the Fed has been hiking. We have said this before. We can't try and match basis point for basis point what the Fed has done. What we need to do is to assess, which is what we do, assess the global economic conditions and the future trajectory of the global economy, identify the channels through which it would impact on the South African economy, both on the growth front and on the inflation front, and based on that assessment, take a view of where the South African economy is going, and then recalibrate policy as appropriate to respond to that. The fact that there are so many other countries that are also hiking is just reflective of the fact that inflation is becoming a global problem. So there can't be South African exceptionalism here, where we would say that well, inflation is happening elsewhere, won't happen here, because we are seeing it happening here, and it is for that reason that the MPC, after assessing the prospects for the South African economic outlook on both the inflation and on the growth side, decided to take the stance that we have taken. Chris, this is a quick calculation. I'm sure you have this at the top of your head.
Yeah, but look, I mean, this kind of question leads itself to a modeling answer, which isn't very interesting. A 25 basis point change in the repo rate generates roughly 0.08% change of growth and 0.12 on inflation. But you have to realize that the forecast that we're showing you prices into the growth rate you see all of the changes to inflation and the repo rate through the forecast period. There are lots of other things going on in the GDP numbers. Thanks.
Thank you.
Thank you. The next question is from Lucanio again, Governor. And it is about the membership's vote, the members' votes. With 2 members voting for 50 basis points, is it a sign that the MPC is turning more hawkish? Given the inflation acceleration is due to external shocks and supply shocks, how effective will lifting interest rates be in containing inflation? A question from Pranisha Naidu again from Bloomberg. What drove your upward revision to South Africa's economic growth forecast? Last question from Lucanio. The governor said policy remains accommodative despite increases in each of the past 3 meetings. What level of the repo rate is regarded by the MPC as neutral? Thank you, Governor.
Did Lucanio say which MPC members voted for the 50 basis points or with? With. Okay, I thought it was unlike him if he was to say which. I think that, okay, let me state the obvious first and say my knowledge of Avery is not very good. So I find it very difficult to identify amongst the MPC members which one is a dove and which one is a hawk. So that becomes complex. What I do know is that the MPC members apply their minds to all the data and information at their disposal, assess the risks to the South African economy on both the growth front and on the inflation front, and then express a preference on an appropriate monetary policy stance. I don't think it's useful to this dove-hawks spectrum is not very useful. But the fact that within the committee there was a consideration of 50 basis points hike tells you the worry that the committee has about the future trajectory of inflation. And we do allude to it in the statement that the risks to the inflation outlook are to the upside. And it is for that reason that you had the MPC considering whether it is 50 basis points or 25 basis points. And just in case, just before you ask, yes, nobody argued for a no change. And you say with the sources of the inflation being external and coming from the supply side, yes, that's it. That's exactly what we said. We say that it's a multiplicity of shocks. But what we as the MPC do is to assess whether there is any evidence of second round effects that are present or imminent going forward. And if they are present or we suspect they will be kicking in going forward within the policy horizon, we will react appropriately. The inflation forecast that we had tried to incorporate as many of the risks that are identifiable as possible, and the risks that we could not quantify, we just alluded that we will have to be cognizant of those risks. So to be clear, we are still of the view that the correct thing to do is not to immediately react to the impact of the supply shock on the inflation outlook, but rather to look at what effect those supply shocks have on the second round of price formations in the economy, and we react to that. We do not have to wait for those second round effects to kick in. We just have to be able to express a judgment that says that this could materialize, and as such, we need to act. Prinesha, the drivers of growth, I think we had identified those. It had to do with the fact that we were starting from a higher point already. Growth last year came out higher than what we had expected, so that already gave us that fillip. Secondly, is that we have experienced a positive terms of trade shock. The prices of South African export commodities has risen faster than the prices of our imports, and that had given a boost to the economy, and we will see that coming through net exports. And we also said that the still accommodative monetary policy stance has actually provided support to both households and firms, and that is actually has actually led to us revising our growth upwards. There was a last question which I must. What is the neutral rate? I think we have it in the sheet that we released with the statement. I think it's 2.3% real, and at the moment the policy stance is still that in real terms, the repo rate is negative, which means that we are nowhere close to that neutral rate, and that is why we keep on saying that the monetary policy stance is accommodative.
Thank you, Governor. I think this can be the last round. We've got two questions from Atol Dlamini at Alliance News. The QPM still indicates gradual normalization through 2024. At what point might the SARB start to consider hiking rates aggressively? What are the contributing factors that might be a catalyst for this change? The second question, is the SARB worried rate hikes might choke growth recovery? Thank you, Governor.
Thank you very much. I think that we had stated this before, and it is worth repeating now, that we believe that the stance that we have taken as the Monetary Policy Committee is appropriate for the state that the South African economy is in, whether it is from a growth side or whether it is from an inflation side. We have taken all of these gradual steps of normalizing policy consistent with the state of the economy. We continually assess the risks. If the risks to the inflation outlook that we had spelled out, that they are to the upside, materialize, we will consider those and reassess our monetary policy stance. And I don't know, when you say aggressive, what that would be. Whether the 25 basis points is not aggressive enough, or is just considered moderate. But whichever way you look at it, the assessment of the committee is that the adjustments that we have taken are appropriate for the state that the South African economy is in. Are we concerned that we could choke off the economy? It is not our desire to choke off the economy. Our responsibility as the South African Reserve Bank is to protect the value of the currency in the interest of balanced and sustainable growth. An economy that is choked can't be balanced, neither can it be sustainable. But we are in no doubt about what our primary object is in terms of the Constitution, and that primary object is that of price stability, and it is that the South African Reserve Bank will continue to pursue.
That was the last round, but there is a last question from Lucanio, if you'll take it.
This looks like a Lucanio-Prinesha press
Yes.
conference.
Will you take it, Governor?
Well, I mean, you want him to stop inviting me in Joburg.
Okay, last question from Lucanio. Given the volatile environment, what level of certainty does the MPC give to its oil price assumption? What are the risks that the forecast might be too aggressive, leading to policy being tighter than needed? Thank you.
Well, we state that the environment is very uncertain, and you ask us how certain are we about our assumptions. I mean, the economic environment is uncertain. We have got a lot of volatility. We do not know what the central banks in the advanced economies will do in what magnitude. We do not know what the impact of the war between Russia and the Ukraine is going to be. We don't know whether it is going to be for a few weeks, a few months, or for a year. We do not know what its impact would be on the global supply chains and on the commodity prices. All of those things matter. At the end of the day, the 2,000 staff members of the Reserve Bank who are behind us in helping us arrive at the decision that we end up having to take also apply them. They give us the input. We assess all of those things, and what we have here as an oil price assumption is what is our best judgment given the uncertainty that we face. And it is for that reason that we say there are risks to the inflation outlook, and those risks are to the upside. And should those risks materialize, the MPC will have to act appropriately and recalibrate policy. Thank you very much. That concludes the proceedings of today.